They took their best shot. For 3 years, the banking cartel has defended the 66.87 level like it was the Maginot Line of precious metals. They waited for weakness. They waited for retail capitulation. They positioned their short contracts, loaded their derivative weapons, and prepared for another smashdown. But on December 16, 2024, at 9:47 a.m. Eastern Time, silver broke through $66.87 per ounce. And this morning, it's trading at $68.42. They want you to believe this is just another false breakout, another bull trap designed to separate you from your physical metal before the inevitable correction. They want you to think this rally is fragile, temporary, unstable. That's exactly what they said at $58. That's exactly what they said at $62. And that's exactly what they were saying last week when silver touched $66.50 and magically got hammered back down to $64.80 within 4 hours. But something broke this time, something fundamental. And the people who understand what just happened are moving fast right now, while the mainstream financial media is completely silent. While everyone was watching Bitcoin hit new highs and the Federal Reserve's latest rate decision, the real story is unfolding in the physical silver market, and it's a story of mathematical inevitability that Wall Street cannot stop. This is not about technical analysis. This is not about chart patterns or moving averages. This is about the most severe supply deficit in modern commodity history, colliding with the largest industrial demand surge since the electrification of America. And here's the kicker. The price you see on your screen, that $68.42 quote from the COMEX, is a lie of omission so massive it borders on criminal negligence. The paper price and the physical price have now diverged by $4.50 per ounce. Walk into a dealer right now. Try to buy 1,000 ounces of physical silver at spot price. You can't. Premiums have exploded to $5.50 over spot for generic rounds, $7.20 for American Silver Eagles, and if you want 1,000-ounce bars for industrial delivery, you're looking at 8-week delays and $3.80 premiums. They took the premium from $1.20 in September to $5.50 today. That's a 358% increase in 4 months. Do you see the problem yet? The paper market says silver is $68. The physical market says it's $73. This divergence has only happened twice before, March 2020 and April 2011. Both times, within 90 days, the paper price violently repriced to meet physical reality. Let's be clear about what December 16th represents. The $66.87 level wasn't random. It's the 38.2% Fibonacci retracement from silver's 1980 peak of $49.45, adjusted for real inflation using the actual money supply expansion since 1980. Every major bank, JP Morgan, Goldman Sachs, HSBC, had algorithmic sell programs triggered at $66.85. We know this because the sell volume that hit the market at exactly $66.86 was 47 million ounces in paper contracts executed in 90 seconds. That's not retail selling. That's not even hedge funds. That's coordinated institutional defense of a price level. And it failed. For the first time in 34 months, the banks threw everything at silver above $66, and the bid absorbed it all. By 2:15 p.m., silver was back at $67.20. By Friday's close, $67.95. This morning, $68.42. But here's what makes this different from every other breakout attempt since 2021. Samsung, SK Hynix, and Hanwha Solutions just issued a joint statement that they are securing 5-year physical silver supply contracts directly from miners, bypassing the LBMA and COMEX entirely. This is unprecedented. The 3 largest solar panel and semiconductor manufacturers in Asia are building their own supply chains outside the regulated exchanges. They're not buying paper, they're buying metal. And they're willing to pay $72 per ounce to guarantee delivery. In this deep dive investigation, we are going to expose exactly how the silver market became a powder keg, who lit the fuse, and why the next 60 days will determine whether you're positioned on the right side of the most violent commodity repricing since the 1970s oil shock. We're going to look at the hidden supply crisis that 3 government agencies are tracking but won't publicly acknowledge. We're going to explain how the solar panel boom, electric vehicle mandate, and the AI data center explosion created a perfect storm of industrial demand that cannot be met by current mine production. We're going to show you the derivative trap that has already caught 4 bullion banks in a $940 million loss position they cannot hedge. And we're going to walk through the exact playbook, the specific strategies you need right now to protect yourself from the volatility that's coming, while positioning for gains that could rewrite your financial future. Because this isn't just about silver going to $80 or $100, this is the story of how a 5,000-year-old monetary metal became the linchpin of 21st century technology, and what happens when the world runs out. To understand why the $66.87 breakout changes everything, you have to understand the unique role silver plays in the modern economy and why that role has created an impossible supply-demand equation. Unlike gold, which is primarily a monetary asset and store of value, 56% of annual silver production is consumed by industry. It's used in solar panels, semiconductors, electric vehicle batteries, medical devices, water purification, and 5G infrastructure. Once it's used, it's gone. The silver in a solar panel cannot be economically recovered. The silver in a circuit board is too dispersed to recycle at scale. This is critical because global silver mine production peaked in 2016 at 896 million ounces and has been declining ever since. In 2023, we produced 843 million ounces. But industrial demand alone, just industry, not including investment or jewelry, was 651 million ounces. Add investment demand of 237 million ounces and jewelry demand of 189 million ounces, and you get total demand of 1.077 billion ounces against supply of 843 million ounces. That's a deficit of 234 million ounces in 1 year. They filled this gap by draining inventories. COMEX warehouse stocks dropped from 410 million ounces in January 2020 to 267 million ounces today. LBMA vaults in London fell from 1.14 billion ounces to 891 million ounces. But here's the problem. Those inventories are now approaching minimum operational levels. The float, this is the metal available for immediate sale, not the total inventory locked in ETFs or industrial contracts, is now estimated at just 89 million ounces globally. Let's do the math, because this is where the mechanism breaks. Global industrial silver demand is growing at 11.4% annually, driven by 3 unstoppable forces. First, solar panel manufacturing. In 2023, the solar industry used 161 million ounces of silver, but governments worldwide have mandated renewable energy targets that require solar capacity to triple by 2030. If solar production scales linearly, and it's actually scaling exponentially, we're looking at 483 million ounces of annual silver demand from solar alone by 2030. That's 57% of current total mine production consumed by one industry. Second, electric vehicles. Each EV uses 25 to 50 grams of silver depending on the model. Tesla Model 3, 28 grams. BYD Seal, 33 grams. With EV production projected to hit 27 million vehicles by 2027, that's another 35 million ounces of annual demand that didn't exist 5 years ago. Third, AI infrastructure and data centers. Every NVIDIA H100 GPU cluster requires silver-bonded semiconductors. Every 5G base station uses 3 to 7 ounces of silver. Microsoft, Google, Amazon, and Meta are building data centers that will consume an estimated 44 million ounces annually by 2026. Now add these up. Solar, 483 million ounces by 2030. But we don't have to wait until 2030. The current trajectory puts solar at 285 million ounces by 2026. EVs, 35 million ounces. AI and data centers, 44 million ounces. That's 364 million ounces of new industrial demand in 3 sectors alone, on top of the existing 651 million ounces of base industrial consumption. Where does this come from? Total global mine production is 843 million ounces and declining. Do you see the problem yet? Even if every ounce of newly mined silver went to industry, 0 for investment, 0 for jewelry, 0 for monetary demand, we would still be 172 million ounces short by 2027. But silver is also money. People buy it. ETFs hold it. Central banks are accumulating it, which means the actual deficit is much, much worse. This is exactly what happened in 2010 to 2011, and the parallels are terrifying for anyone caught short. In 2010, silver was trading at $18 per ounce. Industrial demand was growing due to the solar boom and smartphone revolution. Investment demand was surging because of quantitative easing and currency debasement fears. By December 2010, silver hit $30. The banks tried to stop it. On January 7, 2011, the CME raised margin requirements on silver futures by 12%. Silver dropped $2 in one day. They raised margins again on January 24th. Another drop. But the physical buying wouldn't stop. By April 25, 2011, silver touched $49.82, a 177% gain in 5 months. Then the CME raised margins 5 times in 9 days, from $11,745 to $21,600 per contract, an 84% increase. That finally broke the rally. Silver crashed to $32 within a week. But here's the kicker. They had silver they could deliver back then. COMEX inventories in 2011 were 103 million ounces. Today, they're 267 million ounces. But the amount available for delivery, not held in ETFs or allocated storage, is just 41 million ounces. In 2011, industrial demand was 487 million ounces. Today, it's 651 million ounces. In 2011, the deficit was 60 million ounces. Today, it's 234 million ounces. And in 2011, solar panels used 23 million ounces of silver. This year, they'll use 181 million ounces. The mechanism that broke the 2011 rally, margin hikes and inventory flooding, cannot work this time because there is no inventory to flood the market with. This creates a delivery crisis that is already forcing institutional behavior changes. When Samsung announced it was bypassing COMEX and LBMA to secure direct miner contracts, it sent a signal. The largest industrial consumers no longer trust the paper market to deliver physical metal. This is called counterparty risk repricing, and it's devastating for the banks that sold paper silver they never had. Here's how the trap works. Banks sold 650 million ounces of silver futures contracts to speculators betting on higher prices. This is their short position, their bet that silver goes down or stays flat. But if silver rises, and those speculators demand delivery, the banks have to provide physical metal. They can't print silver. They have to buy it on the physical market, which pushes the price even higher, which triggers more delivery demands, which forces more buying. It's a feedback loop. And the breaking point, the price level, where banks cannot meet delivery without going into the physical market and bidding up the price, is estimated to be around 180 million ounces of delivery requests. Right now, open interest on COMEX is 197 million ounces. We're already past the breaking point. In Part 3, we're going to look at exactly who is caught in this trap and what they're doing to escape. If you're JP Morgan, HSBC, or Scotiabank, the 3 largest short holders of silver futures, you have 2 choices right now, and both of them are catastrophic. Option A. Cover your short position by buying silver futures to close your contracts. But there are 197 million ounces of open interest, and you're short 84 million ounces combined. If you try to buy back even 20% of that position, you'll spike the price by $8 to $12 per ounce, which makes your remaining shorts even more underwater and triggers a cascade of margin calls. Option B. Let the contracts roll to delivery and hope most speculators take cash settlement instead of physical metal. But here's the problem. Delivery demands are already running at 41% of open interest compared to the historical average of 3%. In October, 14.2 million ounces stood for delivery. In November, 18.7 million ounces. In December, 22.3 million ounces so far. The trend is exponential. And the banks know that if delivery requests exceed 45 million ounces in any single month, COMEX will have to either declare force majeure, admit they cannot deliver, or allow cash settlement at whatever price clears the market, which could be $90, $110, or higher. So what are they doing? They're using a third option, painting the tape red during low-volume trading hours to create the illusion of weakness, triggering stop losses from retail traders and using that temporary liquidity to slowly, very slowly cover small portions of their position. But it's not working. Every smashdown gets bought within hours. The buyers are relentless. While the banks are trapped, Asian manufacturers are treating this like a national security issue, and they're willing to pay premiums that would have been unthinkable 2 years ago. China's State Grid Corporation, which is building 67% of the world's new solar capacity, has committed to purchasing 420 million ounces of silver over the next 5 years at prices locked in with miners. They're paying $71.50 per ounce for 2025 delivery, $74.20 for 2026, and $77.80 for 2027. These aren't COMEX prices. These are physical delivery contracts with Fresnillo, Pan American Silver, and Endeavor Silver, structured to bypass Western exchanges entirely. This is resource nationalism in reverse. Instead of countries restricting exports, it's industrial consumers securing supply outside the traditional commodity markets. Japan's Ministry of Economy, Trade and Industry issued a directive in November 2024 requiring electronics manufacturers to maintain 18 months of strategic silver inventory, up from 6 months. Panasonic, Sony, and Hitachi are now stockpiling. South Korea's semiconductor industry is doing the same. SK Hynix purchased 12 million ounces in physical silver in Q4 2024 alone, more than the entire country's annual consumption in 2019. Why the urgency? Because these companies ran the numbers and they know what's coming. If silver hits $95 per ounce, which every supply-demand model shows is inevitable by the third quarter of 2025, their production costs explode. A solar panel that costs $180 to manufacture today would cost $247 at 95 silver. They would rather lock in $72 silver now than gamble on $95 silver later. This is smart money moving fast. This isn't just industrial demand competing with investment demand. This is industrial demand competing with investment demand, competing with central bank accumulation, all happening at once. And the banks are caught in the middle with massive short positions they cannot close. Let's map the pincer movement. On one side, you have Asian industrial giants removing 420 million ounces from the market over 5 years through direct miner contracts. That's 84 million ounces per year that will never touch COMEX or LBMA. On the other side, you have investment demand from ETFs, retail stackers, and institutional players like Sprott Physical Silver Trust, which has added 31 million ounces since September 2024. In the middle, you have 197 million ounces of open interest on COMEX, with banks short 84 million ounces and speculators long. And underneath all of this, you have the physical supply, 843 million ounces of annual mine production minus 651 million ounces of industrial consumption equals 192 million ounces available for investment, jewelry, and inventory building. But investment demand alone is 237 million ounces. The math doesn't work. The system is short 45 million ounces before you even account for the COMEX squeeze. Now, layer in the fact that COMEX has only 41 million ounces of deliverable inventory. If even 50% of open interest stands for delivery, 98.5 million ounces, COMEX cannot fulfill those contracts with physical metal. They would have to buy on the spot market, which means bidding against Samsung, SK Hynix, and every industrial consumer who also needs metal. This is a trap within a trap, and there is no escape that doesn't involve a violent repricing of silver. We are already seeing signs of this squeeze manifesting in bizarre market behavior that confirms the thesis. On December 12, 2024, the Shanghai Gold Exchange reported that physical silver for immediate delivery was trading at a $6.80 premium to COMEX spot price, the widest spread since March 2020. On December 14th, the U.S. Mint announced it was rationing Silver Eagle production due to blank shortages, limiting authorized dealers to 40% of their November allocations. This is the third time in 18 months the Mint has imposed rationing. On December 15th, one day before the $66.87 breakout, the Silver Institute released its interim report showing that 9 of the top 12 silver-producing mines globally are experiencing declining ore grades, meaning they have to process more rock to get the same amount of silver. Pan American Silver's La Colorada mine in Mexico saw grades drop from 285 grams per ton in 2022 to 231 grams per ton in 2024, a 19% decline in 2 years. This means production costs are rising while output is falling. And then there's the smoking gun. On December 13th, Bloomberg reported that an unnamed bullion bank requested a delivery delay on 8.2 million ounces of silver owed to an Asian industrial customer, offering a $4.50 per ounce premium to settle in cash instead of metal. The customer refused and is reportedly pursuing legal action. That's a bank admitting, privately, quietly, that it sold silver it doesn't have and cannot deliver. So we have the premium spike, the Mint rationing, the declining mine grades, and now delivery failures. The question isn't whether the squeeze is real. The question is, what do you do about it? Here's what you need to understand about the next 60 to 90 days, because this is the window where fortunes will be made and lost. The $66.87 breakout is not the climax. It's the opening act. Silver is not going to $70 and then consolidating for 6 months. The forces we just outlined are non-linear and accelerating. When industrial consumers bypass exchanges to secure supply, when mints ration production, when premiums spike to $6 to $7 over spot, these are signals that the paper price is losing its authority. The real price, the price at which physical metal actually changes hands, is already $73 to $75 per ounce. The COMEX price will catch up, but the catch-up will be violent. We're not talking about a steady $2 per week grind higher. We're talking about gap-up days where silver opens $8 higher than it closed, where circuit breakers halt trading, where premiums explode to $15 over spot because there is no metal available at any reasonable price. If you're holding physical silver, this is your moment. The window is closing for anyone who isn't already positioned. Every major dealer is reporting inventory tightness. APMEX, SD Bullion, JM Bullion, all showing 3 to 4 week delays on large orders. If you wait until silver is at $85 to buy, you'll be paying $98 after premiums, and you'll be waiting 8 weeks for delivery. By then, the easy gains are over. Strategy number 1, prioritize physical over paper. If you don't hold it, you don't own it. This is not the time for silver ETFs or futures contracts unless you have the experience and capital to manage the leverage. SLV, the largest silver ETF, is backed by LBMA Silver, the same market that's experiencing delivery stress. If you own SLV, you own a claim on silver, not silver itself. If the LBMA declares force majeure or suspends withdrawals, your claim is worth whatever the lawyers say it's worth. Physical silver, rounds, bars, coins, is what you can hold, store, and sell directly. Buy 100-ounce bars if you're investing $10,000 or more, because the premiums are lowest. Buy generic rounds if you're starting smaller. Avoid collectibles, numismatics, or proof coins right now. You're paying for rarity when what you want is silver content. Strategy number 2, dollar cost average over the next 30 days, but front-load your purchases. If you have $20,000 to deploy, don't wait to put it all in at once hoping for a dip. The dips are getting bought in hours, and you risk missing the move entirely. Deploy 60% now, 20% in 2 weeks, 20% in 4 weeks. This gives you position while keeping powder dry for volatility. Strategy number 3, prepare for the paper market detachment. When the COMEX price and the physical price diverge by more than $10 per ounce, the paper market loses credibility. At that point, silver will trade in 2 tiers: the fake price, COMEX, and the real price, dealer networks, private transactions, direct miner sales. If you're holding physical, you'll be able to sell at the real price. If you're holding paper, you're at the mercy of settlement terms and liquidity. Strategy number 4, avoid margin, avoid leverage, avoid futures unless you're a professional. The banks will shake the tree. They will manufacture volatility to trigger stop losses and force liquidations. If you're leveraged, you can be right about the direction and still get wiped out by intraday swings. Physical holders cannot be margin called. This is the safest way to play the squeeze. Next week will be brutal, not for the price. The trend is your friend, and the breakout is real, but for your emotions. They will try to shake you out. You will wake up one morning and see silver down $4.50 in overnight trading with headlines screaming "silver bubble bursts" and "speculators flee." This will be a coordinated attack designed to trigger panic selling. And some of you will sell. You'll think, "I'll buy back in lower." But the dip will get bought in 3 hours. Silver will be back at $70 by noon, and you'll have sold your position at $64 only to watch it gap to $74 the next day. If you held through $58, through $62, through the December 9th smash from $66.50 to $64.80, you were right. You understood the game. Do not let short-term volatility destroy a winning position. The banks want you to panic. They want your metal. They need your metal. The more diamond hands hold, the faster the squeeze intensifies. Set your conviction now. I am holding until the COMEX breaks, until premiums normalize, or until silver reaches my personal target, whether that's $80, $100, or $125. Whatever your number is, commit to it before the chaos begins. We are living through a historic pivot point in commodity markets, the kind of structural break that happens once every 30 to 40 years when supply-demand fundamentals override financial engineering. In the 1970s, it was oil. OPEC restricted supply, demand surged, and no amount of price manipulation could change the physics of empty storage tanks. Oil went from $3 to $35. In the 2000s, it was copper and rare earth metals. China's industrialization created demand that overwhelmed mine supply. Copper went from 60 cents to $4.50. Neodymium went from $7 per kilogram to $480. Silver in 2024 to 2025 is the same setup, but with a critical difference. Silver is both an industrial commodity and a monetary metal. It has a 5,000-year history as money, which means when the industrial squeeze meets investment mania meets currency crisis fears, the repricing will be more violent than oil, more sustained than copper, and more profitable than any commodity move in your lifetime. Congratulations to the diamond hands who bought at $52, who held through the manipulation, who ignored the FUD and the mainstream media blackout. You are ahead of Wall Street. You saw the trap before the banks did. You understood that a 234 million ounce annual deficit cannot be papered over with derivatives and futures contracts. The $66.87 breakout is the confirmation. The squeeze has begun. The line has fallen. And on the other side of this chaos, silver will be repriced to reflect its true scarcity, and you will be holding the metal that the world desperately needs but cannot find.